Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our commentary on market and economic events. Let's get started. As if people have not had to deal with enough difficult news, this video is going to deal with an incredibly depressing subject, the U.S. federal budget deficit.
No, God! No, God, please, no! 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 No!
But I think it's really important at this point in time, as it looks like Congress is getting closer and closer to approving a stimulus package and approving a budget framework for the next year that's going to mean an awful lot of new borrowing. And we have a Federal Reserve that, based upon the comments that we are getting from the minutes of their meetings, they are laying the groundwork for a big change in policy. So we're getting the potential for real clarity on how much new borrowing is going to be coming from the U.S. government and how helpful the Fed is likely to be next year in having that borrowing be financed by new printed money. We need to take a look at what those two things might mean for financial markets as we move to the back half of the year and into 2022. So let's pull the lens back and let's look at the rather depressing but really important history of the U.S. budget deficit over the last 20 or so years. And when we do that, let's make sure that we keep in mind two different concepts. Because when I talk to people about this topic, they get mixed up all the time about the annual deficit, how much money do we need to borrow this year, and the total debt that the U.S. has incurred, not just with this year's borrowing, but last year, the year before, and all 250 years of our history. Okay, so deficit, what do we need to borrow this year? Debt, how much in total have we borrowed? All right, so when we start with the deficit, if we spin all the way back to 2000, you will not believe this, but we didn't have a deficit. We were actually running a surplus. Can you believe it? But of course, Washington being Washington and things being what they were, that surplus didn't last very long. We actually ended that surplus about 2003, pretty much so simultaneously with our invasion of Iraq and Afghanistan. Wars are expensive. All right, so our deficit went away. We started running our surplus went away. We started running an annual deficit of about $400 billion a year, because in addition to starting wars, we also cut some taxes and so forth. All right, but 400 billion, and then you see a big, gigantic drop. And this, of course, is 2008 and the global financial crisis and the collapse in tax revenue because of the deepest recession since the Great Depression, and huge expenditure on unemployment insurance, bank bailouts, and so forth. So, gigantic deficit of over $1.4 trillion. First time in our history that we had ever borrowed that much. Boy, that was a record that wasn't going to last long, though. Okay, so President Bush leaves office. President Obama comes into office and basically inherits this $1 trillion deficit. And for the next couple of years, we keep running $1 trillion deficits, 1.2, 1.3, 1.4. And then something extraordinary started happening. Our annual deficit actually started going down. Now, is this because President Obama and Vice President Biden were fiscal conservatives and they wanted to cut back on spending and they wanted to raise taxes? They probably wanted to raise taxes, but I'm sure they weren't that happy about cutting back on spending. But what happened here was very similar to what happened back here. How did we ever get a surplus? Well, we had a Democratic president and a Republican House and Senate. And the Democratic president might have wanted to spend, but the Republican House and Senate wouldn't do it. And the Republican House and Senate might have wanted to cut taxes, but the Democratic president wouldn't do it. And so when you put those two opposition forces, Republicans can't cut taxes and Democrats can't spend, hey, we got a surplus. And in the case of 2010 to 2016, well, we were still running a deficit, but this is the most amazing reduction in the deficit that we've seen since the end of World War II. We basically went from a $1.4 trillion deficit to when President Trump took over, we were looking at about a $400 billion deficit, a little bit better than back here. Wow, isn't that amazing? But of course, what happened in 2016? Well, we got a unified government. Just like back here when President Obama was running trillion-dollar deficits, he had a House and Senate in Democratic control, unified government, big deficits. Whether it's Democrats or Republicans, unified government tends to be big deficits. All right, so fast forward here, we got unified government, this time in Republican hands, and lo and behold, that was the end of the improvement in the deficit. The deficit started increasing catastrophically to where it looked like 2019 we were on track to run about $1 trillion deficit, $900 billion trillion. Okay, now another really horrible thing happened along the way. COVID. And when COVID happened, not only did tax revenue collapse, but there were PPP loans to businesses. There were extraordinary unemployment benefits. We did far more to fight the COVID recession than we did to fight the great financial recession of 2008. And you can see it in our deficit. The deficit blew out to $3 trillion. I find it just difficult to even conceive of this level of borrowing. It's 3 times what we did, or 2 times what we did back in 2008, 2009. All right. And what happened in 2020? Well, we got unified government again. We got a Democrat in the White House, Democrat in the House and the Senate, and they're looking to run a deficit of about $3 trillion again. Now, these are CBO projections, and we don't know how accurate they will prove. But remember, because it is difficult to get, the Democrats don't have the overwhelming numbers that they had back in 2009, and it's a 50-50 tie. So a couple of moderates have a huge amount of influence on budgetary matters, and the CBO thinks deficits will collapse back to $1 trillion. So we're going to go from 3 trillion, which is mind-boggling, to 1 trillion, which used to be the most that we'd ever spent. And we're going to stay at about $1 trillion if the CBO is right until the baby boomer retirement really kicks into high gear, and then we're going to go back towards 2 trillion. This is the grim picture of the borrowing habits of the U.S. government over the last 20 years. Our total debt is now $28.5 trillion. And that's important because the total size of our economy is $22.7 trillion. For the first time since World War II, we have more debt than we have, the debt is bigger than the size of our economy. Okay, how in the world, you might ask yourself, could we have financed all of this debt, these huge $3 trillion annual deficits, and looking to have to fund another $3 trillion deficit this year? How could we have possibly done that and yet have the stock market break out to all new highs? Interest rates fall to all-time lows. Well, to understand that, you got to know what happened on September of 2019. It was an extraordinary event in U.S. financial market histories because for the first time, when we had low unemployment, 3.5% unemployment. Remember, no one knew COVID was coming. We had 3.5% unemployment. The economy was growing pretty well. Nothing's wrong with anything. But the bond market in September of 2019 collapsed under the weight of this escalating budget deficit and the fact that we had 3.5% unemployment. So people were buying cars, they were buying houses. People in the private sector wanted to borrow and do things with their life. And the US government, because of the deficits that the Trump administration was running, it needed to borrow $1 trillion. And those two were conflicting, and they couldn't finance all this debt at the prevailing interest rates. And so the bond market, the key financing mechanism of the bond market, overnight interest rates hit 10%. And there was obvious upward pressure on interest rates. And the Federal Reserve, for the first time when we weren't facing a recession or a war, said, well, we can't let interest rates go up just because we have this massive deficit. And the president's saying really mean things about us on Twitter. We got to do something. So in September of 2019, without a war, without a recession, the Federal Reserve started printing money and buying government bonds so that they could help the Trump administration finance this giant deficit. Now, that grieves the wheels because, man, you fast forward about 6 months later and we really do have a crisis. COVID has hit and we're going to have to borrow a ton of money. Well, they went from printing enough to finance $1 trillion deficit to printing enough to help finance a $3 trillion deficit. And they committed to that for the long run. And they also took interest rates to zero. They did everything conceivable to help finance this. And they have continued that. All right? But, and this is the big but, with the recent release of Fed minutes for their July meeting, they're starting to talk about when are we going to stop printing money and buying government bonds. All right? And they are now talking about there are kind of three phases that you go through when the Fed transitions from printing money to not printing money. First, you keep doing what you're doing and you tell people, I'm thinking about slowing down. Then you slow down. Instead of printing $120 billion a month, you say, I'm going to drop to $100 billion. And then in a couple of months, if everything goes around, I might drop to 80 billion and then 60 billion. You taper down the amount that you print slowly and incrementally so people can kind of get used to it and markets don't get too upset and so forth. Then when you have tapered all the way to zero, then you can start talking about maybe if circumstances warrant, we can start thinking about raising interest rates. This is exactly the process the Fed went through back here. The Fed printed trillions of dollars to help finance these deficits. They slowly tapered from that practice, and then they started raising interest rates. And then they even started running the machine backwards and unprinting money and selling bonds into the marketplace. So that's the process that they're saying. We want to do what we did back here. We want to slowly wean the government off of us buying so much debt from them. Then when we have totally weaned them off of us buying debt, then we'll see if we can raise some interest rates. So what the Fed's kind of signaling is 2022, that'll be the tapering year. And then if you want to link about raising interest rates, that'll be kind of 2023 maybe. All right, so why do investors need to understand all this? All right, since September of 2019, the U.S. has borrowed a little over $5.5 trillion. Okay? The Federal Reserve has printed $4.5 trillion. So what that means is for the last kind of 2 years almost, the Fed, the government has borrowed a huge amount and has only had to finance about $1 trillion. Let's call it $500 million a year. Okay? In 2023, when the Fed has fully tapered all this down, the deficit is still going to be $1 trillion or more if the CBO is right. So that means instead of the government having to finance $500 billion, they're going to have to finance a full $1 trillion. What will the interest rate increases need to look like for that to happen? Don't know. But I would have to imagine there will be interest rate increases, and it won't be all in 2023. Because remember, every month that goes by, as the Fed tapers down the amount they print, you get closer and closer to moving from the $5 trillion the government's had to finance for the last couple of years to the $1 trillion they're going to have to finance for a long time into the future. So that's what the markets are looking at. That's what they're grappling with. Why aren't people freaking out? And I think the reason is right back here in September of 2019. September of 2019, when the government was having trouble financing its deficit at an interest rate that the Fed felt was consistent with the economy doing great, the minute that happened, when there was no crisis, there was no COVID, there was nothing, 3.5% unemployment, they cranked up the printing presses. And I think the market is implicitly betting that if the US government has any problem financing $1 trillion, then the Fed will crank those printing presses right back up. And I think, based upon history, we have to agree with them. He's a monster. Thanks for joining us for Market Insights. We hope you found it informative. If you did, we hope you can like the video and share it with your friends. Also, if you'd like to see some of our other research, you can find it at our website, caravelconcepts.com. Thanks.